Good morning. We are half an hour away from the opening bell in Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Rebecca Choong Wilkins.
Our top stories today. Beijing takes fresh steps in response to U.S. tariffs, seeking trade talks at the WTO. The U.S. Postal Service, meanwhile, reversed its decision to halt shipments from Canada and Hong Kong.
Now, records tumble for holiday travel and movie attendance this Lunar New Year, but consumer spending in China remains stuck below pre-pandemic levels.
And the world's top EV battery maker, CATL, said to consider filing for its Hong Kong listing as soon as this month in the city's biggest share sale in recent years.
Good morning. The story across equity markets right now is one of a really mostly up-day story across markets, across different sector groups. Volumes are not quite there just yet. On the benchmark itself, we're up for a third straight day, so that's not a bad winning streak as well. S&P futures, we are in the thick of earnings season in the U.S. Of course, we'll unpack some of the big results that have come out the last few hours or so, plus some of the China angles, like Qualcomm, for example, talking about their market on the Chinese mainland. A quick glance, of course, at the yield curve right now, 2s into 10s. We have a rate decision coming through out of the Bank of England later today. Taking rates down, expected to at least to 4.5%. You look at what the survey says as far as where this actually goes longer term. 3.5% is the terminal rate. At 125, we're actually back above the 50-day moving average. A lot of that has to do with the fact that, you know, a lot of the majors have also rallied against the U.S. dollar over the last 2 days or so. Flip the page, and we're focused in on, well, speaking of iron ore and commodity markets, as you can see on your screen, Saudi Arabia raising their prices for Asia by about $240 a barrel. When you look at things like wheat, for example, we're coming off a little bit. We're still near three-month highs as far as wheat prices go. And, of course, a big story across coffee. This is Arabica, by the way. $4 a pound here. Record. Well, that's a new record, really, when you look at the supply situation over in Brazil. I think we're up 11 straight days on coffee prices. Okay, very quickly, the approach to the open today, and keep in mind when you look at equity markets onshore, it's really about the IT and the AI plays there. We are called higher going into the open today. Nothing much to tell you about as far as the renminbi is concerned. The 10-year yield, as you can see, flats at about 1.6%. Rebecca.
Thanks, Dave. Yeah. Well, circumspect is the way that one trader described yesterday's trading as the onshore Chinese markets returned after that long Lunar New Year break. The question really is whether we see the reality of a trade war settling in, if that's reflected in trading today. We have the first Commerce Ministry briefing since, of course, Donald Trump introduced that 10% tariff across all Chinese goods. We also have the regular MOFA briefing, so watch closely. Quite a few big headlines and quite strong statements coming out from MOFA yesterday. Keep watching that. Elsewhere, onshore, of course, quite a sort of, cautious start to the return of trading. But AI stocks is where we saw one bright spot. Just to put it into context, SMIC, for example, up 8% there, despite the sort of overall drop. We had about just shy of 1% in the CSI 300 down yesterday. Waiting to see whether SMIC can catch up with its H share, which rose about 60% to a record high through this week. E-commerce stocks, again, in focus after we had this sort of flip-flopping from the U.S. Postal Service suspending, allowing deliveries of those small packages from China and Hong Kong. Energy stocks, again, also in focus off the back of some of this trade and tariff news. And then on the Hang Seng China Index, it's this key 7,500 level that we are watching. We breached that for the first time earlier this week. For the first time in 3 months, I should say. The question now, can we see sustained momentum to stay above this 7,500 level? And finally, just in that consumer space, Yum China earnings coming in today, of course, will be one indicator among some of the others that we're expecting from Lunar New Year, some of these high-frequency data that's coming in that will give us and tell us something about the state of consumption in China, Dave.
Yeah, it comes out later today. I could use myself some KFC, actually. One of my favorites. Although, Personal opinion, I'm going to caveat this before I say it. I actually think KFC in Hong Kong tastes slightly different from what I'm used to. Anyway.
You're going to start a big fight here, Dave.
Yes.
I can tell.
Well, okay, let's go with McDonald's then. Fairly more consistent. As Rebecca was pointing out, of course, the Foreign Ministry held that briefing yesterday. They touched on many things. You had Panama. You had, of course, the U.S. Postal Service issue. You had the forced transfer of people from Gaza. And, of course, they also talked about the White House and that decision on tariffs. Have a look.
What we need now is not unilateral additional tariffs, but dialogue and consultation based on equality and mutual respect.
China is increasing its objection to President Trump's 10% tariff, filing a complaint at the WTO that calls for talks with the US. Our chief North Asia correspondent, Stephen Engel, joins us now from Hong Kong. Steve, just tell us what we know so far.
Well, we knew that they were going to file this complaint to the WTO. The big question is, will it work, right? The Trump administration obviously taking, through executive order, a much more unilateral approach to slapping these tariffs onto China, whereas Beijing wants to show that they are a champion of multilateralism. So they are taking this to the WTO. In that filing, they say that the U.S. moves to slap China with 10% tariffs were imposed on the basis of unfounded and false allegations. And that the measures at issue not only violate WTO rules, but are discriminatory and protectionist in nature. So that's essentially their statement. And we can also, because we haven't gotten that phone call yet between Donald Trump and Xi Jinping, if we're going to get it at all this week. But we did get, as David just ran through, and we just heard from the spokesperson from the Ministry of Foreign Affairs, or MOFA as we know it, they basically had a number of different allegations against the United States. And I have a graphic, and you can see the 5 main points on fentanyl, because the basis of that 10% tariff was on the fact that Trump says China hasn't done enough to stop the precursors shipping out of Chinese factories. The spokesperson said the U.S. uses fentanyl issue as a pretext for tariffs. The fentanyl issue is a U.S. domestic problem. That's something state media has been hammering on all week. China is one of the toughest nations on drug enforcement. The U.S. disregarded our help on fentanyl, he said, and imposed tariffs. And, of course, China opposes this tariff action and urges the United States to correct its act. So in lieu of a conversation between the two men where they can possibly reach a gentleman's agreement on further action, we are in a state of limbo right now. There could be further action. China held back. They didn't go heavy on agriculture. That was the big issue in the first term when China retaliated against soybeans and others. And during those first 2 years of the Trump administration, the first Trump administration, soybean sales to China from the United States dropped 80%, hit U.S. farmers to the tune of about $11 billion. China hasn't done that now. They've built resilience into the system. They've relied more on Brazil and others. Also, just the last point I want to make, the Apple App Store now in the focus of possible antitrust investigation. That could be potentially another lever that China can use down the road. They're going to spread this out if they can't reach an agreement.
Yeah, the timing of the Apple story is certainly interesting. What about this decision from the U.S. Postal Service to, well, reverse their earlier decision not to halt shipments from Hong Kong and China?
12 hours of confusion, right?
Yeah. Classic flip-flop.
That's right.
Literally.
Okay, so the USPS put out a statement on its website devoid of details, other than we're not going to temporarily suspend the influx of packages, not letters, packages from China and Hong Kong. Now, we all assumed, and it probably was, as a result of Donald Trump adding to those 10% tariffs, this removal of the exemption, this loophole, the minimus exemption that allowed last year 1.4 billion packages like these flooding off the conveyor belts to come in from around the world into the United States, many of them from China, obviously. The numbers absolutely soared over the last decade, especially the last couple of years, as Shine and Temu and others really had direct-to-consumer without having to pay duties or have inspections at customs. Well, the removal of this exemption basically puts the onus on the United States Postal Service to inspect 1.4 billion packages, 4 million a day.
Wow.
They couldn't handle it, so they kind of panicked. I'm just going to say it. Sorry, USPS. They kind of panicked, but then there was a backlash. So they've removed that, and now they are accepting all packages and letters. We'll have to see how this one plays out.
Steve, thank you so much. Stephen Engel there, our Chief North Asia Correspondent. Let's bring in Homin Lee, Senior Macro Strategist at Lombard Odier. And Homin, good morning, and thanks for joining us. I mean, I noticed you commented as well yesterday on the story, as it pertains to the potential impact on e-commerce. I'm wondering whether, this flip-flop represents something larger than simply a sort of indirect impact on e-commerce, and just broadly, can we apply this as almost a blanket risk to many sectors in China that might keep investors away for now?
Well, first of all, it's at least slightly positive that the USPS wanted to be pragmatic about the enforcement of the new de minimis rule for these parcels from China to the U.S. But the bigger picture is that this type of volatile policymaking will continue to target China, in our view, given the atmosphere in Washington, D.C. There's a pretty firm bipartisan consensus to be tougher on China, and now it's a core of Trump's agenda. So it's probably prudent for the investors to assume conservatively that we haven't seen the worst in the U.S.-China relations yet. It's likely on the horizon, and this is one of the reasons why we think, at least for the foreign investors, accentuating China-related risk at this juncture, apart from using China as a diversifying trade within the emerging market equity allocation, is still a bit difficult. So we'll simply have to see what's the greatest extent of the restrictions and tariffs we can get from the U.S., maybe over the course of this year. And that's also the risk that could potentially weigh a bit on the market as we now face the lead-up to the NPC, which could also produce some positive noises for the market. So this basically is one of the reasons why we continue to maintain a neutral stance on Chinese equity market.
Homin, Rebecca here. I want to ask about the NPC. What would it take for you to shift out of neutral into overweight? What do you need to see from the NPC, and can Beijing deliver that?
So what we expect from NPC, because if you think about the December policy meetings, there was guidance for greater fiscal deficit and central government bond issuances. But we haven't gotten the figures yet. So the figures, it seems that the consensus is forming around official budget deficit target being raised from 3% usually to 4%, and maybe 2 to 3 trillion yuan's worth of central government bond issuances. That might be in the price already, because these are the figures that were discussed in the early phase of the stimulus euphoria in fall last year. So what will change our mind would be much more aggressive fiscal package that at the central government level over the multi-year horizon, or more aggressive plans for the local government interventions in the housing market. We are getting some guidances, but we don't have specific details there yet. Or much weaker currency that allows for aggressive monetary policy easing, and support for the stock market and also the banking sector. We are not there yet in terms of concrete policies from Beijing. But if these policies are launched, in a more firm manner, then that will certainly help us change our minds on China's equity market.
Right. So, Homin, if it's not China for now, so I think two separate questions. If you're if you have an EM mandate, what then takes up sort of the void that China, to your point, is neutral right now? Is it India? Is it something else? Or if it's a broader sort of global mandate as well, is it simply just U.S. exceptionalism that dominates that portfolio?
We continue to focus on the U.S. risk for the time being in our portfolios, especially for the equity allocation. Yes, there has been some challenge from the China's AI ecosystem in the past few weeks, but ultimately, we think the cheaper AI in the midst of industry-wide move toward inference actually increases demand in the long run. And I think many large U.S. tech companies are very favorably positioned for that. And of course, the U.S. stock market itself will likely get some boost from the likely move toward tax cut discussions in Congress in the middle of the year. So that's still on the horizon, and that will likely be supportive for the stock market and, of course, for the U.S. economy. So we continue to focus on the U.S. factor. For the other markets, we still like Japan. The domestic economy remains pretty firm. We continue to get pretty good wage data and inflation data out of the country. Corporates are enjoying pretty improving pricing power. So that's another good story there. We continue to focus on. And finally, elsewhere in Asia, we think that the market environment for India is beginning to improve. It is true that the market has gone through a bit of cyclical swoon in past few quarters, but we think the Reserve Bank of India will start cutting interest rate and injecting more liquidity, maybe with some tolerance for weaker rupee. And this combination will start helping, especially the large cap companies in the India stock market. So after 10% correction, in our view, it's becoming a little more interesting story. So these are the other markets that we favor within the equity allocation in our portfolios.
Homin, thank you so much. Enjoy the warm weather in Singapore, the cold weather, of course, there in our studios. Homin Lee, their senior macro strategist at Lombard Odier. The renminbi fixer today is out. Let me just look at my screen and to tell you what it is. There we go, 716.90. Isn't that exactly the one yesterday, or am I imagining things? Any case, of course, that doesn't seem to be, at least for now, that's about just under 1,000 pips spread to the estimates, which is the other figure you see on your screens. Right, we're counting down to the open of trade. The Thursday session is about just under 14 minutes away in Shanghai, in Shenzhen, and here in Hong Kong. Futures are, last I checked, pointing to a flat start. Good morning. This is the China Show.
Bloomberg has learned that CATL is considering a filing for its Hong Kong listing as soon as this month or early March. Our reporter, Felipe Pacheco, is across this story. What details do we know so far? What are the highlights here?
Rebecca, it's quite interesting to see that this deal is moving forward. It's one of the biggest deals that we are expecting for this year. And as you mentioned, the filing is expected to happen by the end of this month or in early March for a deal that could happen before the end of the first half. We're talking about $5 billion for an IPO here in Hong Kong of around that size. Of course, the terms of the deal are not set yet. It's at early stage, as we can tell, but at the same time, there's a lot of eyes on this deal. There's a big lineup of banks that are expected to actually join. And the bankers, IPO bankers, ECM bankers here in Hong Kong are eager to see their names tied to this deal. We're talking about Goldman Sachs potentially joining the lineup, also UBS and Morgan Stanley, to a list that already has CICC, JP Morgan, and Bank of America. So you have some of the biggest banks out there trying to make sure that this deal moves forward and just gives a boost to the market here in Hong Kong.
I didn't hear HSBC from you. Well, we know what happened there. On the HSBC story, we know that they lost this mandate in Europe. So what do we know about this?
That's correct, David. Let's say that this is the opposite of what we are seeing in Hong Kong right now. We have a bunch of banks that are eager to see the market coming back. A big deal as CATL would just bring a lot of activity and energy to the market, but HSBC is going the opposite direction. We had news from our colleagues in Europe showing that the bank is being taken out of the lineup of the underwriters for a very important deal in Europe. In Germany, actually, it's a drug maker that's expected to raise around 1.5 billion euros in Frankfurt. And that's because HSBC was quite clear last week in their message to the market that they are withdrawing within investment banking in markets such as the US, Europe, to focus in the Middle East and here in Asia. Well, the bank, which is one of the private equity companies behind the drug maker in Germany, was quite quick to say that they are thinking of replacing HSBC with Bank of America for this deal in Germany. I think that this is a quite clear indication that we should see more of this happening with HSBC in the future. Maybe the bank will not be winning new mandates in those regions specifically, or will be taking out of the lineup for some of the deals that we already know. It's a strategy. They are clear about it. It's not that surprising. It's more of a consequence of this new strategy that the bank made quite clear.
Felipe, fantastic. Felipe Pacheco there, our reporter, on all the latest ECM news out there. Right, we have more coming through, by the way, on the auto sector coming through later today. We'll dig into, of course, the potential industry impact of the Trump tariffs with Goldman Sachs in just a couple of minutes here. The approach to the open today, nothing's happening. How does it look? It looks like this. This is Bloomberg. Good morning. So it's quiet out there. We're trading sideways across most of the benchmarks so far. The dollar is, of course, coming off a two-day slump. We're trading sideways across most major markets. There's a rate decision today out of the Bank of England. In any case, it's a deloading week, as they say, and certainly we need that given the heavy news flow and how busy things have been of late, Rebecca.
Yeah, absolutely. And I think the big sort of theme today will be this flip-flop by the US Postal Service. We're really looking at e-commerce companies that were caught in the crosshairs of this. Of course, we have some fast fashion companies, think about Shein, for example. They rely on sending these cheap parcels, high volumes of cheap parcels into the US as part of their business model. So, yeah, keeping an eye on some of this. You can see Alibaba there down 0.5% or so, but Bilibili taking quite a brunt there, 2% down so far.
We're looking at shares of Xiaomi, and, you know, as you look at this context here, right, so that, well, the news is we now have a rough understanding of when they'll be putting out, I think, two new things here. It's a high-end EV, and, of course, also on the handset. We'll have Goldman Sachs later on, by the way, to talk us through their outlook for the EV sector in China, because they think it's, apart from the OEMs themselves, the battleground in Chinese EV business will be in software and some of these navigation systems. So we'll unpack some of the sort of opportunities there. It's worth mentioning that $40 Xiaomi is really one of the best performing stocks, if not the best performing stock across some of the major names in Hong Kong. $40 effectively puts you at the highest since, I think it was a IPO back in 2018. In the case, of course, some bright spots as we move into the Thursday session. 3 minutes away, this is the China Show.
Welcome back. You're watching The China Show. We are counting down to the open of markets here, Dave, and looks like we're perhaps in store for a relatively quiet start to the Lunar New Year. It wasn't a great day of trading yesterday, pretty brutal, in fact, for some areas. Yeah, and I think one of the sectors, to your point, we'll be watching today in particular will be some of the IT and tech and AI-related shares in mainland China yesterday. Really the bright spot, as you point out, the difficult start to the Year of the Snake. Given all the news so far, so we, every now and then we need a quiet day, and it looks like we're going to get one today. And we'll see. The open is looking like this, as Rebecca was pointing out, on the Hang Seng China Index. It's at 7,500 level. We broke above that. We've been trading above that for about 2 days or so. So in the event of a down day, that is, I guess, the next psychologically important support level to watch. There we go. As we mentioned, the IT index, bottom of your screens, is on 0.5%. There's really not much to tell you about as far as what's going on there is concerned. We're down about 0.1 of 1%. There's a story, of course, we talked about CATL looking to apply for a listing within the next couple of weeks, and our story certainly also outlined some of the banks involved and the potential, how the deal team actually looks like for that listing here in Hong Kong. We also have some numbers coming through. This is out of CCTV, so call it official numbers. Plus 7% on spending
to that amount in US dollars, although if you compare that on a sort of per capita basis, I think we're still below 2019 levels on a per capita basis. The Hong Kong Open is looking like this, please. Flip the boards. And as you look at that, I'm just going to change the page here so I can look at my notes. Hong Kong, nah, nothing here. Nothing here. HSBC, of course, we talked about, is losing its IPO mandate there over in Europe. And very, very quickly here, some earnings coming through Bank of Hangzhou and nearby, Bank of Ningbo, also out with earnings. I think one is up 6%. The other one was up double digits. The other report to tell you about is some of the projects of this developer are progressing smoothly, according to one report. And we'll talk about the Xiaomi thing later on. Of course, they're coming out with the timetable for the release of that new EV vehicle.
Yeah, Dave, I mean, just to your point, Dave, about some of this Lunar New Year spending figures that are now coming through, it does look like Chinese consumers shattered travel and box office records this Lunar New Year holiday, defying some of those concerns that we had about a slowdown in consumption. Let's bring in our China correspondent, Min Lo. Min, just give us a breakdown of some of the data that we've seen so far.
Yeah, so we got a really robust set of numbers from the official government data. Record high in terms of rail travel, record high in the number of trips made in a day. And if you look at total revenue, that's up 7% from the previous year. Total number of trips made was up 6% compared to the previous year. But of course, the most important thing that we're looking for is the per capita spending. That is still slightly shy of 2019 levels. It's close to, okay, what you see on the screen now is the rail travel, that's a record high. But as I said, per capita spending is slightly shy of 2019 levels, close to 170 yuan per person, but 2019 levels was 176. So if you look at the provincial breakdown, though, the big powerhouses like Zhejiang, 0.8% higher than 2019. Guangdong was 2% higher. So we're seeing some green shoots here. And as well, if you look at the outbound travel, 7.7 million trips made compared to 7.2 in 2019, again exceeding pre-pandemic levels. So bear in mind, though, that it's one extra day in this year's Lunar New Year holiday compared to 2019. Plus, some people took an extra 2 days off to make it an 11-day stretch, so that might have boosted the numbers a little bit as well.
Yeah, I think to the point you're making here, Citi calling this quite a solid start
yes.
to the year, the snake year. So in terms of the spending patterns that have started to emerge, what are we seeing here?
So if you look at the private booking platforms like Fliggy, which is owned by Alibaba, we're looking at people going for heritage site visits, cultural experiences, local immersion experiences. Road travel has seen a double-digit increase from the previous year. So we're seeing this shift in trend from going for luxury purchases to accumulating experiences instead. And if you look at the top destinations overseas, they're Japan, South Korea, Thailand, the nearby countries, whether it's because it's more affordable or whether it's because geopolitical tensions had led to a souring of sentiment, people not wanting to travel to Western countries, I don't know. But one interesting trend I want to tell you about is what happened in Shanghai over Lunar New Year. There was a big parade of luxury cars on the streets of the French concession. And that's very interesting because, so a group of South Koreans, remember China has given out this 240-hour transit-free policy for many countries' citizens, including South Koreans. So they came to China and they said, oh, we had a really great experience, but one thing we noticed is there aren't many luxury cars on the road. And this just exploded on social media. And suddenly all these rich people just crawled out of the road, the woodwork and, drove their luxury cars out onto the streets and became a local tourist attractions. You can see the social media footage. There are plenty of people out on the streets and generated a lot of debate on social media as well. Some people are saying, don't let the South Koreans leave thinking that they're better than us. Don't let them, look down on us. Others are saying if you're true Shanghainese, you wouldn't be, flaunting your wealth so ostentatiously. This is really distasteful. So it's really interesting. But what's clear is there's a lot of national pride in China right now.
Yeah, there's no better way to flaunt your muscle car than a traffic at a standstill, really. There we go.
Yeah, I haven't seen that in the 3 years I've lived in Shanghai.
Wasn't this at the French concession?
Yes, in the French concession.
Yeah, it used to be a very quiet, it's a very quiet part of that part of the city, and clearly not anymore.
They're probably still, they're barely going at 5 miles an hour. They're just crawling along there.
Yeah, okay, well, South Koreans and their opinions, and look what you guys did. Look how they responded now. Min, thank you so much. Min Lo, our China correspondent there. By the way, coming up in the next hour of the China show here is a closer look really at the hotel sector and what's taking place at the trends we're seeing with the tourism consumer recovery, of course, as Min just pointed out there. So H World Group will be joining us coming up here on the China show. Okay. Let's talk a little bit more about this consumer story. So as we pointed out here, China is calling for talks with the U.S. at the WTO after Donald Trump imposed his blanket 10% tariff. Now, China responded with a targeted set of curbs on its own. But Bloomberg opinion columnist Shuli Ren thinks that this time around, Trump actually has the upper hand, and the focus is on the health of the Chinese consumer. She's with us now, and take us through what the thesis is here.
So in the global trade war, David, the economy that has the most powerful consumer base basically wins, right? And unfortunately, that insight seems to have gone missing in Beijing. After 2018, when Trump launched his first trade war and an ugly divorce from China, what Beijing did was basically doubling down on its industrial policy, trying to achieve technological self-reliance and independence. On the other hand, they pretty much ignore the welfare of China's middle class. And what you see is that a lot of people, a lot of families had months of very brutal lockdowns. And when China came out of COVID zero at the end of 2022, consumers looked around and said, oh, the economy actually has long COVID. And what has happened since is that they have hunkered down. People are spending less. They're paying more attention to the notion of self-care. Basically, taking road trips, doing camping, running, all these things, they don't cost very much, but people feel like they're feeling a little bit better about themselves, right? And I think that's a fatal mistake because last year, consumption accounted for only 1/3 of the total GDP growth versus 2018, consumption accounted for more than 2/3. So what happened last year was that basically China managed to grow the so-called 5% only because of strong exports. And that basically put China's economy in a very vulnerable position when Trump launched his trade war, which no one expected he would do because no one thought he would become president again.
Shuli, what can China actually do now? And is what we're seeing so far too little, too late?
I think China basically has no good choices at this point, and the president Xi has to make some sacrifices. I mean, we've been talking about stimulus forever, right? Like since late September, and not much has come about. And the economists broadly agree that China needs something like 4 or 5% of annual GDP as stimulus on top of the current spending. And that's quite difficult because China's debt to GDP ratio is already at 300%. That means that Xi Jinping has to tolerate more debt in the Chinese economy. Another thing is the Chinese yuan, right? Like there's a lot of capital outflow already, right? And then everybody thinks the yuan will have to weaken a lot if the tariffs go up to, say, 30, 45, 50%, right? And the PBOC has been reluctant to weaken the yuan fix. And that's something that they have to tolerate as well.
Shuli, thank you. Shuli Ren, our Bloomberg opinion columnist. You can check out, by the way, her column today on your terminal. Also on the terminal right now, in fact, I'm just looking at this story. This scoop is now, the one on your screens, is now actually the third most read story in the last hour or so. Yeah, sources are telling us that some of the senior partners at McKinsey are actually now questioning, is it actually worth doing business in China? Whereas, of course, if you juxtapose this to the lucrative North American business, it might not be worth the risks. Check out the details of that story, of course, on your Bloomberg terminal.
Yeah, and also coming up today on the China show, Goldman Sachs joining us to discuss the impact of US tariffs on China's auto supply chain. That interview is coming up next, so stay with us. This is Bloomberg.
Welcome back. You're watching The China Show. Legendary short seller Jim Chanos says President Trump's 10% tariff against China won't make really much of a difference right now. Investors simply need to wait and see whether the trade war actually escalates. Now, China spoke to us exclusively about Trump's move and also China's response.
Again, wait and see, but I think that 10% isn't going to do it, by the way. You would have to raise them substantially on both China and the EU, and we haven't seen that yet. So we'll have to see what exactly comes within 30 days, 60 days.
More on tariffs now. Now, Goldman Sachs has been looking at which Chinese suppliers have the highest exposure to the US and their sensitivity should a trade war drag on for months. For more, let's bring in Goldman's China Autos analyst and the author of their latest report, Tina Hou. Tina, let's just kick off with the big, simple question. Where are we seeing the biggest vulnerabilities to US-China trade war when it comes to that supply chain?
Right. I think in terms of the overall auto supply chain, if we break down by OEMs and suppliers, first of all, I want to preface by saying it's a very fluid situation and the tariffs are changing to China, to Mexico, Canada, so it's a lot of still uncertainties out there. But if we look at, first of all, the OEMs, actually the overall China auto export to the U.S. is very limited. Last year, China exported about 5.4 million vehicles, but only about 2% is directly to the U.S., and then those are actually mainly to European brands. So I would say the China OEMs have very limited exposure. On the other hand, there are the suppliers that supplies to foreign brands, the U.S. brands, Japanese, European brands that have sales in the U.S. market. And then among our coverage companies that we see up to around 25% revenue exposure to U.S. sales eventually. But then among this, about 15%, up to 15% is actually already localized U.S. production that are not subject to any tariff. About 5% or so is production in like Mexico and Canada, so maybe subject to 25%, but now it's delayed. Right, yeah. And then the other about 5% would be directly produced in China and exported. But overall, based on our sensitivity analysis in the report, we think the risk is relatively controllable. And if we look at what the market has been saying and the share price movements, it seems like it's not really making a big impact at this stage. But we still need to wait and see what happens next.
And I think on the extreme end of your sensitivity analysis, let's say we get to that point where it's worst case. What about the ability to pass on the tariffs to say the customer? Is that something to consider? Right.
So I think the sensitivities involve, first of all, the duration of the tariff, right? It could be because I think in the announcement there is the condition. If something was improved, if something was met, then the tariff might go away or might be reduced. That's number one, the duration. Number two is among all of the suppliers that we speak to, they do mention that the OEMs tend to share the tariff burden with them, at least 50%. And then if we look at what happened back in 2018 during the first round of tariff, it was the fact that OEMs do share the tariff with the suppliers.
I mean, even just when we think about this market domestically, there's an enormous amount of competition. What do you think is driving that for 2025? And are we expected to see consolidation? Are we expected to see players being driven out this market?
Right. If we look at what happened in 2024, overall passenger vehicle volume grew by over 5%, mainly supported by the government policy started from the third quarter, fourth quarter. And EV penetration actually surprised to the upside, 48% penetration and 40% volume growth. Very competitive in the market. Around 112 new EV models was launched last year. If we look at this year, it's sort of a continuation. The government subsidy is continuing. We see the EV penetration rising to 60% this year, so that would imply 30% volume growth. And based on our calculation, there will be around 120 new EV models launched this year, so even more than last year. So that would imply competition will definitely continue in this market. Yeah.
Tina, I just want to quickly follow up on that. I mean, last year we wrote the story about visiting the Guangzhou export-import market, and we saw this great variety of different types of EV vehicles, so both passenger vehicles but also industrial. How are you seeing that split? Are we going to see more more commercial use EVs?
Yeah, I think the trend in commercial EVs is also rising, but it's sort of behind what we have seen in the passenger vehicle. Going forward, it's likely that the penetration for commercial EVs will rise also, mainly driven by the reduction of battery price, because for commercial vehicles, it's less about the design, the smart cabin, it's more about the cost and the utility.
Yeah, and so just to clarify then, the NEV penetration rate here that you see to 60%, this is for the retail car market, or is this overall?
This is for the retail, domestic retail.
Okay. I also want to point out one of the things you mentioned here is, so the battleground moves, obviously there's a fierce battle between OEMs. I mean, 120 models. How confusing can this market be? But also when it comes to the navigation systems as well. Talk to us about what you expect to see there over the next 12 months, and who are the companies best positioned there in that space?
Right. I think especially this year, it could be the so-called takeoff year of autopilot or navigation on autopilot. Over the past 12 to 6 months, we've seen the OEMs, their technology and then the functionality on their autopilot, not only highway, but also in urban roads, improve greatly. And the other trend is that lower-priced vehicles are now equipped with the autopilot function. Last year, around like 200,000 RMB vehicles and above, it almost became a standard configuration for them to compete effectively in the market. This year, we're seeing that price band move down to around 150,000 RMB, even 120,000 RMB. Wow. So it's definitely becoming more and more of a focus for the OEMs.
And what names should we be watching here? Which are the names that are most vulnerable versus most resilient?
We see all of the OEMs are focusing and then trying to develop and catch up on the autopilot functions. Some of them are using their in-house technology, which have been relatively leading the market because they put in the investment earlier. And then some others are trying to catch up, both catching up on the in-house R&D. At the same time, they are leveraging external third-party suppliers to quickly produce the model so that they can maintain or grab market share.
Yeah, just briefly, your outlook on pricing trends this year and also margins.
Yeah, we actually had a post-Chinese New Year pulse check expert call yesterday. So the January order is actually down by 35% versus December. So obviously not a very great outlook. That being said, we do expect, starting from February, the competition to pick up. As for majority of the OEMs, what we're seeing is that their current order backlog does not support more than 1 month of delivery. So they also want to pump up the order book. What they will do is that now we're seeing they're offering more financial policies, such as 5-year zero-interest loan or like the insurance subsidy, rather than directly cut price on the vehicles. But effectively, this is still another sort of like price cut or price competition.
Tina, thank you so much. It's nice to see you, by the way, here in our studios. Tina Hou there, China Autos analyst at Goldman Sachs. It's a mixed picture across these equity markets. CSI is down. Here in Hong Kong, we're slightly to the upside. Plenty more ahead. This is the China Show.
Welcome back. Here are some of the major corporate stories that we are following today. Chinese e-commerce firm JD.com is said to have renewed its interest in acquiring German electronics retailer Economy. Sources say JD recently approached a German firm about a potential deal and has started sounding out its largest investors, shareholders. The Chinese company has been hunting for ways to expand amid weakness in the domestic economy. Tesla's sales in Germany fell 59% last month, with less than 1,300 new cars registered for its lowest total since July 2021. That was in a market where EV sales overall jumped 54%. The company's struggles may be connected to Elon Musk's political activities. A YouGov poll taken in mid-January suggests many Germans viewed the CEO unfavorably. And a group of Morgan Stanley-led banks have sold $5.5 billion worth of debt tied to Elon Musk's social media platform X, offloading around half the exposure they've been holding since the 2022 purchase of what was then called Twitter. Sources say the loans sold at 97 cents on the dollar. The banks still have $6 billion of X-related debt on their balance sheets.
Right, so if I look at markets right now, so there's really not a lot happening. There are some sort of 2-3 sigma moves we're seeing really, and some names here, and this is really down to the earnings season that is well underway over in Tokyo, and maybe increasingly we're getting into that over in South Korea. Nomura is a really big one to watch. It beat estimates on trading revenue, so as you can see, the stock was up as much as about 8%. SK Biopharma is also an earnings story, 40 billion won for the fourth quarter operating profit. So yeah, plenty more ahead here on the China Show. Welcome back. You're watching the China Show. 30 minutes into the cash market session. CSI 300, bottom of your screens. This is MSCI China. CSI is coming up. There we go. Flats on the onshore benchmark. The broader benchmark, as you can see, is down about 1.4%, down to some of these consumer-facing names like Baidu, Meituan, Haidilao, AIA Group, Ping An, Tencent are all down about 1 to 3%, give or take. The other story, though, across these markets is really one that is longing of a narrative. So, I'm going to do a cop-out here. And as you look at the Asia dashboard, Asia Pacific, so the headline yesterday was stocks are down on trade war concerns. The headline possibly today is stocks are up as trade war concerns ease. Maybe. There we go. It just changes day to day. It's difficult to be a financial journalist, right? So play the game with us. If you could. There's a rate decision coming through today out of the Bank of England. Majority, or virtually all, except for like 1 or 2 names, are actually expecting them to cut interest rates to about 4.5%. The terminal rate right now, based on the survey, is 3.5%. So still ways to go there for the Bank of England. The story on the macro front, there are 2 things here. These Besant comments on the Treasury market, and also what's happening with dollar yen. For the first time in about 6 or 7 weeks, we have a 152 or below a 152 handle here on dollar yen. Why? Mark Cranfield's about to tell us why. He's joining us out of Singapore. Yeah, Mark, why?
Well, good morning. Earlier in the week, we were talking about how do you tell people about what's happening with the US dollar, and we were talking about the euro, which most of the time the euro-US dollar cross rate is the one that really defines it, and sometimes the Japanese yen takes over. Today's one of those days, certainly. So it's a few things falling into place. We saw yesterday labour cash earnings very strong, feeds into the BOJ narrative that they're going to be able to raise interest rates again because wages are going up as they wanted them to. Then today, along comes the BOJ's Tamura telling people that they should expect interest rates around 1% in the second half of the year. Now, the interest rate curve in the yen at the moment is not priced for 1% at that time. In fact, before she spoke, there was only one more 25 basis point hike priced in, and that was for October. So in terms of pricing, there needs to be a readjustment. That's obviously positive for the Japanese yen. What you're also seeing is the difference, the yield gap between the US and Japan is gradually narrowing. That's obviously positive for the yen as well. And people are starting to think that maybe the US dollar is getting a little bit overdone in general, which will help other G10 currencies. So all of that is starting to fall into place. The yen probably has the most catch-up of any major currency, positioning before this week was still pretty short, net short on the Japanese yen, not as big as it was when dollar yen collapsed back in August, but still reasonably large. So those positions still need to be unwound. We saw huge trading volumes last night in Japanese yen options, and most of the big stuff was for strikes 150 and lower, down towards 145. So clearly traders are shifting their emphasis, expecting more downside for dollar yen. Now, all of this, of course, it all sounds bullish in the short term, but don't forget, the Bank of Japan got a lot of attention for being the cause, so-called, of the dollar yen slide, which roiled global markets in August. So if dollar yen falls too fast, maybe the Bank of Japan can't raise rates as quickly as they want to, because people will be looking at them and saying, you're causing this problem. It's a very fluid situation, but for now, clearly, the market is turning much more favorable on the Japanese currency.
Mark, just taking a bit of a step back here and thinking about the tariff story, to Dave's point in your introduction, feels like markets are searching for a narrative when it comes to how to make sense of what's going on now between China and the US. Is that why we're seeing this sort of slightly lackluster performance in markets today? What do they need to see to start actually, I don't know, trying to make sense of the shape of what's going to happen?
We were discussing this yesterday, actually, probably after your program had already finished. But I think we're moving towards the stage where it's going to be much more of a stock picker's world in equities. Because of this friction and uncertainty, like look at this situation with the US Postal Service. They ban products coming in from Hong Kong and China for a few hours, then they reverse it. All because it may affect US e-commerce platforms. This kind of uncertainty, back and forth on tariffs being on, tariffs being off, restrictions being on off. For the overall market, it's very disconcerting. But if you look at specific sectors, there are very strong stories. In the case of China, for example, AI-related companies who are benefiting from what DeepSeek is already doing, those stocks are performing very well this week. There are sectors related to metals, which could be to do with tariffs. Those are performing well. There's high volatility in other areas, and of course the property sector is lagging. What you see going under the hood in the Chinese markets may well start to happen in the rest of the world as well. People won't be able to decide on the overall direction of an index, but they will see banking sector may do very well, certain parts of the AI related will do very well, other sectors will drag behind. You need to be very good at picking your stocks if you want to make money this year.
Mark, just your thoughts on the implications of these comments coming out of the U.S. Treasury Secretary. I mean, the exercise to bring borrowing costs down is not so much, I guess, pressuring the Fed, if I could just borrow that phrase, but really more in the Treasury yield space and bringing the 10-year yield down. What are the implications of that?
Well, they announced a Treasury auction last night, quarterly auction, and there was less emphasis on long-term bonds. So if they stick to their word and they do issue more in the short end, less in the long end, you will naturally get more demand for bonds in that area. Yields can come down a bit. You'll get a flatter yield curve, which is happening at the moment. The curve is starting to flatten between 2 and the long end of the curve. That will probably continue. The US Treasury is still issuing an enormous amount of debt. They still have a huge deficit in America as well. The Treasury yield curve will continue to be very volatile. There will be comments from time to time from people like the Treasury Secretary, and the Fed themselves have to make their own decisions whether to raise or lower interest rates based on what they see in economic data. That doesn't change the inflation outlook at all. Doesn't matter what the Treasury Secretary has to say. The inputs into CPI are a different factor altogether. That's more to do with general cost and balances in the US government, demand factors, lower taxes, all that kind of thing. The Federal Reserve may hear what he has to say, and it's got nothing to do with whether they make interest rate policy at all. They will be looking at the next CPI data, which happens to be next week as it happens. So a very big week for the US markets in terms of is the inflation, is the change in policies we're seeing from the White House, is it already infected inflation, or are we going to have to wait a little bit longer?
Bloomberg's live strategist Mark Cranfield there. Thanks very much. Now, we are also keeping an eye on chip-linked stocks in Asia following earnings reports from Qualcomm and Arm. Shares of both fell in late trading. Our tech reporter, Annabelle Jewellers, joins us. Annabelle, let's start with Qualcomm. What are the key takeaways that we should have been watching for?
Yeah, well, it was a pretty interesting release because actually after Qualcomm reported, the stock rose in late trade, but then just before the earnings call started, it started to dip and you saw it ultimately closing 5% in the red. It tells you that there's a couple of different aspects that investors have been sort of clinging to in the numbers. So initially there was sort of the optimism really that this had been a pretty strong report. We saw outperformance across a range of different sectors. There was encouraging signs of end user demand. So earnings per share, for instance, they were up 24%. We saw revenue as well beating estimates, and the outlook as well for the quarter that we're in right now was also pretty strong because they're saying that it could come in around $10.3 to $11.2 billion. That was above the projections. What sort of sparked the concern, though, and why possibly we started to see the stock dip was what is the licensing business. And this is where they're sort of saying they could see sales of between 1.4 or rather 1.25 to 1.45 billion dollars. The estimate had been for 1.4. It's obviously a much smaller part of the business, but it still is based on an average projection of the amount of smartphones that are going to be sold. So if they're expecting less revenue, it also tells you that their outlook for the smartphone market isn't as great either. So that's possibly why we saw that drop.
What about ARM? Tell us about that.
Yes, this is another one, of course, and it sort of follows what's been a pretty big week of tech earnings because we had AMD as well. But when you put those two together, the industry outlook isn't too great. And so that has sort of been the concern. So cautious revenue forecast essentially for the current period. So revenue is going to be between $1.18 to $1.28 billion in the fiscal fourth quarter. That runs through the end of March. That is, of course, in line with a lot of projections on Wall Street, but people still have these expectations that we're going to continue to see that AI rally extending. And so the loftiest that we had seen tipped were around $1.33 billion. And so even if you do sort of come in line, it just has never really been enough to satisfy investors in this tech story either. So, yeah, that, of course, it adds to the other concern we have, which is more broadly around DeepSeek and a smaller AI model. Do you need so much compute power moving forward?
And just quickly before we let you go, ARM's majority owner SoftBank is in talks about its acquisition of Ampere. Just tell us what we know.
Yeah, that's right. So just quickly, sources are saying a deal could be announced in the next couple of weeks. The valuation could be $6.5 billion. It's something we've been reporting as soon as last month or as early as last month. Of course, these could always fall over. But what's interesting as well is the valuation, $6.5 billion. Back in 2021, we had reporting then from Bloomberg that SoftBank was interested in a minority stake of the chip designer, and it was at a valuation of $8 billion. So it really does speak to the amount of competition that's in the space now as well.
Bill, thank you. Animal Jewelers there on the latest in earnings. Speaking of earnings here, so we are in the thick of things. So we talked about the U.S. We're just past the hump, let's put it that way, although you still have a few big names coming through as well out of the U.S. So that's the U.S. story for now. As you can see, nearly 80% have actually surprised to the upside. The story across Japan, though, and this is as of about halfway through as of this morning, so a couple of hours back. The story across the Nikkei 225, I think we're about 60% through. 60% have actually reported beat there, so that's been a decent earnings season. We talked about Tamura earlier on and getting market reaction there. And set to report later today, you have a few big names coming through out of Tokyo. Should be coming out either in about an hour and a half or right after the market close. Some big names on your screens. And over in South Korea, also some names on your screens and just how they're doing ahead of some of these key earnings releases.
Yeah, and still ahead, coming up, we have Chinese e-retailers on edge after the US Postal Service flip-flops on accepting parcels amid the trade and tariff turmoil. We assessed the latest risks next. Stay with us. This is Bloomberg. McKinsey and Company partners are said to be questioning the consulting giant's presence in China. Sources say some argue the lucrative North American business can offer more than offset a China retreat amid some of the geopolitical risks that we are seeing. Our chief North Asia correspondent, Stephen Engel, has the details of this Bloomberg scoop. Steve, tell us what we're hearing.
Yeah, you know, we've been covering this for the last few years, obviously, since the Chinese government sort of launched a bit of a crackdown, if you want to call it that on multinational consultancies in China, whether it's Bain and Company, which saw its offices raided in China, Capvision found it embroiled in some sort of anti-espionage campaign. It is headquartered in New York and in Shanghai. McKinsey, it's an interesting story, obviously, probably one of the bellwethers of global and U.S.-based consultancies that have businesses around the world in 130 cities across 65 countries, including in China, where it's loss-making. And you mentioned about North America being, could potentially offset if they did have a retreat. Half of its revenue comes from the United States, and it loses money in China. But again, the global managing partner, Bob Senfelds, maintains that McKinsey is a global company, right? So it is a dilemma right now, and we're hearing in an exclusive story that is #2 on the Bloomberg terminal, most read right now, essentially that McKinsey senior partners are speaking up anonymously. They don't want to necessarily put their names to this, but increasingly they're questioning the presence in China, given the heightened geopolitical risks, given the fact they're not making money right now. They did pull back headcount in China by about 150 employees. They have 1,000 or so, and they have, according to their website, about 1,500 client engagements in China. They're active in China, obviously, but is it worth the risk? And it really highlights the growing dilemma of a number of American companies that are doing business in China. That latest survey in January from the American Chamber of Commerce in China said a record 30% of American companies are either considering or have already considered or already starting to pull out of China because of these heightened geopolitical risks, national security risks from both governments.
Bloomberg's chief North Asia correspondent Stephen Engel there with the very latest on that McKinsey scoop.
Yeah, okay. From one big breaking news story to another. Okay, this one is actually has to do with this, what was supposed to be a very big merger and deal here to combine Japanese, your big Japanese automakers, Honda and Nissan. So we now understand that the Nissan President, this is based on reporting out of Asahi News, is telling the counterparts at Honda that they are ending their integration talks. And of course, this, while it is a significant development on the story, it should not come as any surprise, of course, because there have been some signs here. In fact, we have a step back piece that talks about really some of the unique challenges to combine that have started to actually unravel. On your screens right now, we are getting somewhat of a reaction, although again, just keep in mind it's not completely out of the blue just now. On a couple of hours back, in fact, TBS reported that the two presidents were to meet anyway this Thursday. And I guess we'll just try and put those two things together once we have more information available for you. But that's the breaking news for now. All you need to know, Nissan President telling Honda they are ending integration talks, according to Asahi News.
And turning back to some of the sort of tariff news that we're following today, David, Washington's closure of the so-called de minimis loophole on small packages from China is clouding the outlook for the U.S. business of retailers, including Shein and Temu. Let's bring in Bloomberg Intelligence senior analyst Catherine Lim here. Catherine, just tell us about the very latest. What's your take on this flip-flop that we've seen overnight?
Right. Clearly, we talked about it yesterday. There's going to be uncertainties ahead, I foresee, particularly this quarter, as the supply chain just grapples with what they need to do, the adjustments that they need to make. And we're also talking about the vendors, sellers on all the different platforms itself. How should they best adjust in this new environment, assuming that we don't get anyone in the supply chain, stepping up on or making changes to rules. Now, I wouldn't rule out the fact that, custom clearance, etc., is going to take longer than expected. And if you look at what Cainiao has posted on its website in US, yesterday itself, it's already warning that, you're going to need another 3 to 5 days for them to actually clear and gather some of the deliveries together. So we'll have to see, whether we get new changes on that front over the next few days.
Yeah, and Catherine, to your point, there's a lot of really uncertainty out there, not just for investors, for executives themselves. And I'm wondering, as we move into earnings season, is there anything specific that you're curious to hear executives and how they, what kind of guidance they can actually give as it pertains to this specific issue?
Right, David, absolutely. It is the guidance in this new environment and what will materialize in this quarter, which is the January to March quarter, as the new rules hits. Are we going to be seeing substantially lower margins? As I do foresee, the Chinese platforms who are trying to actually make inroads, not just in US, but, also in the rest of the world, whether they are going to forego some of these profit gains just to secure their market share. US remains, a fairly lucrative business, given that, we're talking about high spending average per shoppers. So, their stance on this, my take is that they're not going to exit the market itself, but really how much do they actually have to sink in more ahead?
All right. Catherine, thank you so much. Catherine Lim, you can check out her research. Just the latest note here on your Bloomberg terminal, on Bloomberg Intelligence, Senior Analyst for Consumer and Tech here in the Asia Pacific. Right, we just want to tell you about this big interview coming up on Bloomberg Television. On your screens will be with the person you see there. We talked about this in the comments he made earlier on in the Fox interview on the 10-year yield. Scott Bessent, U.S. Treasury Secretary, joining us live as the Trump White House implements their agenda on things like tax cuts, spending priorities, and tariffs. On your screens, 1 p.m. Thursday, if you're watching out of the East Coast, 2 a.m. if you're up already or still up in Hong Kong, and 5 a.m. if you're watching out of Sydney. Welcome back. More on this breaking news story that just out in the last few minutes or so. Asahi reporting that the Nissan President is telling Honda that they are ending integration talks. Danny Lee, our transport reporter, is here with us to talk us through this. They're talking about a divorce even before they got married.
Yeah, it's almost a quick tie-up and a quick kind of separation. And it really comes as Nissan is not happy with the proposal on the table from Honda to no longer be a partner of equals. It's always important in a marriage like this, but in fact, this will be Nissan being more like a supplicant, a subsidiary, which is not what they want, given it's a proud Japanese company. It wants to be in control partly of its own destiny, and therefore the two presidents of Honda and Nissan meeting today, and it's almost a dead-on-arrival deal here. So, yeah, it's the latest development in the twist of what is turning out to be quite a saga, but for Nissan, given its weakness, ultimately whether they'll be in a position to call the shots here because of its financial weakness, its strategy weakness, and the effectively companies circling around it to see what can happen next, and obviously the Japanese government as well, who wants to see its auto industry thrive under this Chinese competition.
Right, so, I mean, there are some who might say that Nissan has overplayed its hand, really, here. What comes next for Nissan? Where can it go from here?
I think if Nissan continues down the path it's on, it's already outlined thousands of job cuts, cost cuts, changes in part of its strategy and output of manufacturing. If it thinks that it is enough to continue to go it alone, then management, on the path it's been on to position it has got itself into, it will be judged by investors, clearly on that. But given the position it has been in, the fact it is 5 times less valuable than Honda, whether Honda will come back with a better offer, whether the parties will be forced by the Japanese government to get a better deal on the table, it remains to be seen. Or if there's going to be a third party that comes into play here, who knows? But clearly, not just Nissan and Honda, but also the likes of Renault, Mitsubishi, other parties who are related to this have been unhappy about this combination as well. So we'll see what happens in the weeks and months. I'm sure in the next 24 hours, I'm sure there'll be more interesting news to come as well out of this.
Danny, thank you so much. Danny Lee there, and as we just wrap up the latest there, as we go into the Japanese lunch break, under 5 minutes away, I can tell you that Nissan shares are now pairing. Their earlier gains were now just up over 1%. In Tokyo, we've now taken out, in fact, the 400 yen mark. A pump. Okay, now on the travel front and the sort of consumer front here, so yeah, the CCTV released yesterday the totals now for the Chunje, which is the Spring Festival, and up on volume, in fact, substantial numbers here, with Citi basically saying this was a really strong start to the year of the snake, although when you look at spending, for example, still below, on a per capita basis, still below pre-pandemic levels. In fact, coming up as well, we'll get you more color here as far as the hospitality industry goes with H World, by the way. So H World Group, right again, joining us in a couple of minutes. Stay with us. You're watching The China Show. Right, welcome back. We're just going into the Japanese lunch break. In fact, speaking of the halfway session, we're about halfway through the earnings season over in Japan. Mostly have seen positive surprises out of corporate Japan. Interesting as well is this big news story which came out a couple of minutes back here that this Nissan and Honda tie-up might be just on the edge. We did see, of course, shares of Nissan, for example, still up into the break, but just coming off a little bit its highs of the day. Speaking of coming off highs, dollar-yen is now trading at about 112.18. For a brief fleeting moment, we were below the 152 handle there on the Japanese currency. Very, very quickly, the story across Asia-Pacific is now I won't spend too much time on this. It's a flat session, and you can just look at that on your screens. Also a fairly even split across sector groups.
We are also looking at spending and consumer in China as we come back from Tundia, the spring holiday. We see travel spending during the 11-day Lunar New Year break in China rising by about 7%, defying concerns of a slowdown in consumption, Dave. And really, we're seeing Chinese travelers sort of have this preference to stay a little bit closer to home when they're traveling. Cultural tours were popular. I think official data said that train travel hit a new record, so still an aversion perhaps to going further afield.
Yeah, I think what's emerged, you're right, is the people are going places. They're not spending as much on big ticket items, but I think it's also the industry starting to adjust to the spending on experience.
Right.
And experiences, right? And, we've talked to a lot of, whether it's airline or travel or hotel CEOs over the last, I would even say going back to the pandemic, and it's really the shift in consumer and purchase patterns that has really shifted in that direction. What does it mean for sort of future plans for the hotel industry in particular? Well, let's get a sense of that, in fact. So joining us now is really the perfect guest to give us some insights here on this, is Jihong, Chief Strategy Officer at H World Group, which, by the way, operates, get this, more than 10,000 hotels in some 18 countries. You guys must be very, very busy. Thank you for joining us today, and, happy Year of the Snake. Why don't we start off with what took place activity-wise at your hotels in mainland China over the last, let's call it 10, 11 days or so. Just give us a sense of how business was.
Thank you for inviting me. We see very strong demand over Chinese New Year at this period. We welcomed more than 83 million guests in our hotels, which is 18.5% increase over the last year. And we also see 68% increase of foreign visitors in our hotels. Of course, Chinese New Year is always a time for family reunion. This year, in addition of going home to visit the families, we also saw very interesting themes across the country. First of all, ice and snow. Northern cities such as Harbin and Changchun are very popular among travelers because of the unique ice sculpture and skiing opportunities, which is really a newly discovered sport for Chinese. Second, cultural heritage. Chinese New Year was declared as UNESCO intangible cultural heritage this year, and traditional cultural activities has been a main attraction for the travelers. Cities like Shantou in Guangdong province and Putian in Fujian province are really hot cultural hotspots this year. Our revenue per available room in Shantou increased about 20% year over year, and in Putian even 30% increase. And thirdly, of course, warm destinations has always been very popular among travelers during this period because of the sunshine and steady weather. Areas like Hainan, Guilin, Kunming are still very popular. This Chinese New Year, we saw revenue per available room in Guilin, for example, increase over 11% year over year.
Actually, that's a very good point, and I'm glad you mentioned that specific metric. So revenue per available room, and I'll read you something that, and I should caveat this, by the way, Jihong, that your stock, I think over 20 analysts cover the stock. The vast majority have a buy recommendation on the stock. Only one, I believe, last I checked, downgraded the stock from buy to hold. That's HSBC. And let me read you what they put in our inboxes yesterday from their analysts. That they downgraded H-World from buy to hold because they expect, to the metric you just pointed out there, revenue per available room, the down cycle, to be protracted. I would imagine this is across the company. Just your response to that.
Well, of course, the hotel industry always look at RevPAR, we call it in the jargon. Our business are very asset-light business, actually. More than 50% of our revenue actually come from franchise fees, which is more related to volume and the number of rooms than pure RevPAR performance. And this trend will continue over the next period. We will continue to build more asset-light business and decrease our directly owned and operated hotels, which means that RevPAR will have less and less impact on our total revenue and profit margin.
Jihong, I want to ask about some of your expansion plans for 2025 and beyond. Where are you seeing opportunities? What are your plans? What's in the pipeline? Yeah. And I suppose, how are you viewing lower tier cities versus higher tier cities? How are you responding to the changes in demand from the Chinese consumer?
Okay, it's a big question. Let me start with consumer patterns. Like in many countries all over the world after pandemic, Chinese consumers also starting to shift their consumption pattern from luxury goods and expensive household items to services and experience. So we benefited really enormously from this trend. In 2024, occupancy rate of our 10,000 hotels is over 80%. And we see this trend to continue. However, we do see that consumers start to be much more cost conscious. Value for money is really a new motto for the consumers. Our guests look for flexibility, affordability, and quality at the same time. That's why our hotels really offer this kind of products. 90% of our hotels are limited services and selected services like Hanting, Ji Hotel, and Orange Hotel. They are really aesthetic, thoughtful, efficient, and most important, they offer guests' requirement without extra costs. That's why our segment really fit right well into the new consumer patterns. So originated in Shanghai with our first hotel 20 years ago, we have steadily expanded our footprint in China and also into the world as well. Today, we manage over 1 million rooms in 19 countries. China contributes about 80% of our revenue, and China is definitely our growth priorities. In China, the quality chain hotels still a very small fraction of market. That's why we see that we have ample potential to grow. And as you mentioned, lower tier cities actually offer much higher potential for growth. Chinese government invested heavily in transportation infrastructure, such as the high-speed rail and highway. They made those remote areas in China accessible with low cost. So today, our portfolio, Yes?
Jihong, if I could just pick up on that, because it's a very good point. Your expansion into lower tier cities, could you talk a little bit more about what specific brands you're looking to roll out this year? And in which cities, if you could tell us about those places as well?
Okay, sure. So currently, about 42% of our portfolio are in Tier 3 cities and below. And about 50% of our new opening and the pipeline are also in Tier 3 cities and below. So we are really looking into expanding to, for example, West China, Central China, really in the lower tier cities. And our network has been expanding very, very well. So in these cities, brands like Hanting, G Hotel, Orange Hotel are very popular among our investors.
And Jihong, just as we close up here, I really want to ask about the travel demand during what has been a difficult time for the Chinese economy. What metrics do you look at to see rebound and demand coming back from that pre-COVID levels?
All our metrics actually has exceeded 2019 in terms of revenue, in terms of EBITDA, in terms of also RevPAR as well. And the number of visits increased enormously as well. So all the metrics and parameters show that recovery of the travel industry is well underway.
Understood. And, we know, of course, you... why don't we put your CFO hat on? Because I know, of course, that's a part of the business that you oversaw as well. What we're going to show our viewers right now is really many metrics. We have revenue growth, and I guess to your other point, because you were a CFO, we actually put cash flows in terms of investing activities, which really highlights your growth potential moving forward. I think your growth between 2015 and 2022, on average, correct me if I'm wrong, was about 15%. You had a very good year between 22 and 23, which was north of a 50% growth in revenue. Can you give us a sense of what your growth target is for revenue this year? Jihong, are you still there?
Yes, I'm still here. Yes. I'm sorry, I cannot disclose any financial information for the outlook because we are still in the process of preparation. But what I can tell you is our revenue growth on the nominal level will probably not as strong as before because we are moving into asset-light business. Our revenue income will more and more come from fee business, which is really cash flow strong and steady as well. So the profit margin will continue to expand. Our cash flow is very strong. In the third quarter 2024, we have 4.8 billion cash flow and 4.1 billion free cash flow. This all shows that our effort in moving into asset-light business has paid off.
Jihong, thank you so much, thank you so much for being such an excellent sport there, taking us through all the numbers and those really important insights into travel demands for 2025 and beyond. Jihong He, their Chief Strategy Officer at H World Group, joining us. Now, if you're a Bloomberg subscriber, you can catch up with all our interviews by using our interactive function TV Go. You can also join the conversation by sending us instant messages. Send them to our team, to our guests during the live show. Please go check it out at TV Go. There is plenty more ahead. This is The China Show.
Welcome back. You're watching The China Show, just looking at markets right now. So actually, there we go. I think things have perked up a little bit further. Hang Seng Index and now the CSI are now showing just the same direction here. Southeast Asia, we're looking at a Singapore Straits Times Index, 0.5%. Speaking of Southeast Asia, coming up on your screens very shortly is the Philippine Composite and how we're trading this Thursday. Big news, big political shakeup there midweek. We have the Vice President, Duterte, the daughter, of course, of the former president, Rodrigo Duterte, becoming the first Philippine vice president to be impeached by the House of Representatives. Now, the move heightens the risks there around the political situation amid this public feud between, well, her family and that of the president, Ferdinand Marcos Jr. Let's bring in our Manila Bureau Chief, Manolo Serapio, to talk us through the latest here. And yeah, well, get us up to speed, Manolo, and what do we expect to happen next then?
So the House of Representatives impeached the Vice President, and then it was that complaint was sent straight to the Senate yesterday, but the Senate didn't tackle it during the plenary session, which was their last for now, and they only would resume sessions in June. The question is whether they will hold special sessions, because it's only the Senate who has the sole power to try an impeached official, and we'll see now whether they will hold special sessions between now and June, or will they wait till June to tackle this?
Manolo, I want to ask how, their respective different approaches to China is playing into this. Of course, quite a change in stance from, one government to the next. How is that playing a role here? How is that affecting the political environment?
With regards to China, the Vice President has really been quiet about it. She has not expressed her views, at least publicly. So I think overall the Philippine strategy towards China remains the same, which is pushing back against China's expansive claims in the South China Sea, or at least in the parts of the South China Sea that the Philippines claims as within its exclusive economic zone. I think we can continue to see that because of the pushback that we're seeing led by the Philippine Coast Guard in terms of making sure that Chinese vessels that are within its exclusive economic zone are warned via radio challenges, via social media, that they are encroaching on Philippine territory.
Right. Now, well, speaking of the South China Sea here, what do we expect in terms of, I guess, there's a new U.S. president, of course. What is the Philippines expecting as far as military support for the Philippines from the Americans? And do you think there would be actually changes to Washington's policy towards China's actions in the South China Sea?
I don't think we're seeing any changes as of yet. I think the Secretary of State, Mark Rubio, was quite clear in criticizing China's destabilizing actions, destabilizing actions in the South China Sea. And he came out with this pronouncement early on in the Trump presidency. I think we will see it continue. And as we saw earlier this week, there was the Philippine-U.S. air drills that happened, which obviously China didn't sit well with China. So it had its own patrols conducted on the very same day, which is near the disputed Scarborough Shoal. What we're watching out for is the military drills, the flagship military drills between the Philippines and the U.S., which will happen around March or April. And I think they're expecting that this will be the biggest so far this year.
Bloomberg's Manila Bureau Chief Manolo Serapio there. Plenty more ahead. Stay with us. We'll be checking markets, digging more into that tariff story. This is Bloomberg. Now to a new phenomena in Chinese media, the mini soap opera. So these are not your typical social media style clip of someone dancing badly or trying out some kind of goofy challenge. Dave, I'm looking at you. But professionally scripted and very carefully produced stories. And global venture capitalists are starting to take note. So to help break us down what we're seeing, China correspondent Min Lo is with us. Just tell us about these micro dramas and how producers make money from this.
Yeah, so they're typically just about 1 minute long or several minutes long, and they're shot vertically so it fits on your phone. It's something you can just watch when you're waiting for the bus or the train. And look, they're over 1 billion internet users in China. Half of them have watched these mini drama series before, and a third of them are scrolling through them every day. So it's a huge industry, 35% growth in revenue last year. And it's, it popped up since 2018 when those short video apps started becoming very popular among young people, and it's been growing ever since. So it's very popular. People are just watching, on their commutes. How the producers make money is because they let you watch maybe the first 10 episodes for free. They're very dramatic. They always end on a cliffhanger. And by the time you got to the very juicy part, then you have to pay. But it's very cheap. It's like $1 for another 20 episodes or $10 for 60 episodes. You've already invested time for the 10 episodes, so you might just shell out the extra $1 for another 20.
Which is funny because it won't even be in 10 minutes if you've invested 10 minutes, into 10 episodes of your time. So how are VCs getting involved here?
Yeah, so they're getting involved because, like many other industries in China, it's a very, very competitive landscape. So there are thousands of new companies that registered last year to produce these short videos. And according to one venture investor, he's saying China produces between 5,000 to 8,000 of these new mini-series every year. That's 10 times more than the tally for the rest of the world. So it's unbeatable experience there. So these Chinese companies, they're starting to break into the Middle Eastern, the Asian market, producing localized content in multiple languages. And where they want to attract Western audience, they usually still have a very big team of script writers, engineers based in China where it's cheaper. And to attract the Western audience, they may just partner with a local studio or hire a small production team in the US, leverage on Hollywood resources. The big risk here is because there's been so much scrutiny over Chinese tech firm. That is one risk, that geopolitical risk. Also, some people are saying, is this just a one-off fad? But given that it's been popping up and growing steadily since 2018, we've really changed our consumption pattern now. I mean, the last time I watched a movie is several months ago, so I think this trend is likely here to stay.
Yeah, we were trying to get to that point yesterday with our interview with IMAX China, right? When was the last time we watched a movie? Well, several months. I can't even remember the last time. When was yours? Christmas?
Christmas.
But these are special occasions, right, to the point you're making. It's not
my dad.
It's not an every weekend thing. Yeah. All right, Min Min, thank you so much. Min Min Lo, our China correspondent. As Rebecca was pointing out, right, social media has given the opportunity for would-be dancers to show off their wares and really overestimate their abilities, if I'm completely honest here. So leave it to the robots, as they say, right? As they take over the world. Speaking of that theme here, robotic stocks are actually on the way up. How's that for a segue? As interest grows on dancing bots. Yeah, and some of the names, as you can see on your screens, that are just short of going limit up in some cases here on sustained investor enthusiasm sparked by dancing bots at the recent Spring Festival Gala, of course, which was there for many people to see.
Yeah, and just on that geopolitical theme, touching back quickly, a reminder about this very big interview we have coming up on Bloomberg Television. US Treasury Secretary Scott Bessent joins us live just as the Trump administration is implementing its agenda on tax cuts, spending priorities and tariffs. That's happening at 1 p.m. Thursday, New York time, 2 a.m. Friday for the night owls in Hong Kong, and 5 a.m. in Sydney. And that's it for the China show today, Dave. Insight with Haslinda Amin is next. Stay with us.